Fed is about to change the game. When interest rates drop, the wealthy are already gearing up to strike gold. What about you? This opportunity might only come once in a decade. Wealth Cipher warmly welcomes you. Follow our channel so you won't miss any powerful insights to help you take control of your financial destiny. Now, let's dive into the analysis. Picture this. You wake up one morning and the headlines read, Federal Reserve announces significant rate cuts. Markets are buzzing, Wall Street is celebrating, and the rich, they're popping champagne. Meanwhile, the average saver, the person who thought keeping money in the bank was the safe move, has no idea what just happened to their financial future. This isn't just a policy change. It's a massive transfer of wealth. And here is the truth most people don't understand. Every time the Fed changes interest rates, money moves. Not just a little money, trillions of dollars shift from one group to another. And if you don't know the rules of this game, you're not just missing out. You're getting played. Now, let me ask you something. Who benefits when the cost of borrowing drops? Is it the average worker who lives paycheck to paycheck? Or is it the people who already control assets, businesses, and capital? You already know the answer. The rich don't just hope for opportunity, they plan for it. Right now, while most people are distracted by daily life, the wealthy are positioning themselves. They're setting up for the next big boom that lower interest rates will trigger. And guess what? These opportunities don't come around every year. In fact, the last time we saw a big move like this, it created millionaires and even billionaires in record time. So what's really going on? Why are these rate cuts such a big deal? And more importantly, what should you do about it? Before we go deeper, you need to understand one thing. Money isn't just about earning and saving. That's what schools taught you. That's what your parents believed. But in the real world, money moves, and those who control its flow control their future. When the rules change, and make no mistake, the rules are about to change, you either adapt or you get left behind. In this series, I'm going to break down exactly why the Fed is even considering cutting rates now. How this one decision could create explosive opportunities in stocks, real estate, and other markets. Why the rich love these changes and how they position themselves to win big. The traps most people fall into when rates drop and how to avoid them. And finally, how you can take steps today to turn this policy shift into your personal wealth-building moment. Sounds exciting? It should, because if you get this right, the next 12 to 24 months could completely change your financial life. So, let's start with the basics. What happens when the Fed cuts rates? What happens when the Fed cuts rates? Alright, let's dive in. You've probably heard this term thrown around on the news. The Fed is cutting interest rates. Sounds technical, right? Like something that only economists and Wall Street analysts care about. But here's the truth. When the Fed moves, your entire financial life is affected even if you don't notice it right away. So, what does a rate cut really mean? Let's strip away the jargon. The Federal Reserve sets something called the federal funds rate. The rate banks charge each other for overnight loans. That sounds small, but it's the foundation for everything. Your mortgage rate, your car loan, your credit card interest, even the rate your bank pays you for savings. It's all tied to the Fed's decisions. When the Fed cuts rates, borrowing gets cheaper. Suddenly, businesses can take out loans for expansion at a lower cost. Homebuyers can grab mortgages with smaller monthly payments. Investors can borrow at low interest and put that money into assets that might earn much higher returns. And what does that do to the economy? It's like pouring gasoline on a fire. Spending goes up, investment goes up, markets get pumped with liquidity, cheap money flows everywhere. Sounds great, right? But here's the catch. This isn't equally good for everyone. Winners and losers of a rate cut, the big winners. People who own asset stocks, real estate, businesses. Why? Because when borrowing gets cheap, people rush to buy things. Companies borrow more, invest more, and their stock prices shoot up. Home buyers flood the market, driving real estate prices higher. But if you're sitting on a pile of cash in a savings account, you're not celebrating. In fact, you're losing purchasing power. Here's why. When the Fed cuts rates, the interest you earn on savings drops. So if inflation is 3% and your savings account is paying you 0.5%, you're losing money every day without realizing it. The rich understand this. They hate sitting on idle cash because they know cash rots when interest rates drop. So what do? They move their money fast. Into what? We'll get there in part 7. Why does the Fed cut rates in the first place? Great question. The Fed uses interest rates like a thermostat for the economy. When things are slowing down, maybe unemployment is creeping up, businesses are pulling back, or consumer spending is falling. The Fed wants to stimulate growth, so they lower rates to encourage borrowing and investing. It's like telling the entire economy, money is cheap, go out and spend it. But there's a flip side. Too much spending can lead to inflation, which is when prices rise because everyone's chasing the same goods and services. That's why the Fed usually cuts rates when they believe inflation is under control or they're more worried about a slowdown than rising prices. Right now, the big question is, are we heading into an era of lower rates after years of tightening? If yes, we could be at the start of one of the biggest money shifts of the decade, rate cuts and the wealth effect. Here's something interesting. When rates drop, not only do assets like stocks and real estate go up, but people feel richer. Their 401ks look better, their home values rise, and suddenly they're more confident about spending. Economists call this the wealth effect, and it can turbocharge the economy. But who benefits the most? People who already have money in the markets. If you're just holding cash, you're not feeling that wealth effect, you're watching it happen to other people. This is why rate cuts are often called a party for investors. The problem, most people aren't even invited because they don't understand how to position themselves. What about the stock market? When the Fed cuts rates, investors cheer. Lower rates mean companies pay less to borrow, which means higher profits, which usually means stock prices go up. Historically, big rate cut cycles have triggered major bull runs in the market. For example, after the 2008 financial crisis, the Fed slashed rates to near zero, and what happened? The stock market had one of the greatest runs in history. The same thing happened in 2020 during the pandemic. The Fed dropped rates aggressively, and tech stocks exploded. Do you see the pattern? Every major wealth boom in modern history started when money got cheap. The ripple effect. Beyond stocks, it doesn't stop with the stock market. Real estate gets hot because mortgages become more affordable. Gold often rises because when rates are low, holding non-yielding assets like gold becomes more attractive. Even cryptocurrencies can surge because people look for high-return alternatives when money is easy to borrow. In short, everything tied to growth and speculation tends to pump. But there's a catch. If you think rate cuts are always good, think again. Sometimes the Fed cuts rates because they see trouble ahead, maybe a recession. If businesses and consumers are scared, they might not spend even when borrowing is cheap. That's called a liquidity trap, but that's rare in the US when markets are optimistic. The real risk for everyday people isn't the economy, it's missing the window of opportunity because they didn't understand the game. Bottom line, when the Fed cuts rates, cheap money floods the system. Those who own assets see their wealth grow. Those who only hold cash get left behind. It's as simple as that. In the next part, we'll uncover why the rich absolutely love these rate cuts and how they already preparing to make a fortune, while most people are still wondering what's happening. Why the rich love low interest rates. Let's get real for a second. When the Fed cuts rates, it's like opening the VIP section of the money club. But guess what? Most people don't even know the party is happening. Meanwhile, the rich, they're not just attending, they're popping champagne bottles with both hands. So why do wealthy people get so excited about low interest rates? Because they understand something most people don't. The cost of money is everything. Cheap money equals leverage on steroids. Here's the secret weapon of the rich: leverage. That's a fancy word for using borrowed money to make more money. When rates are high, borrowing is expensive. You want to buy a building. The interest alone might eat your profits. You want to expand your business. Same problem. But when rates drop, oh man, it's game time. Suddenly you can borrow millions at dirt cheap rates. And if you can earn more on those millions than you pay in interest, you're making money out of thin air. Think about it. If you can borrow at 3% and invest in something that returns 8%, you pocket the difference. Scale that up to tens of millions, and you see why billionaires love the Fed. Assets go boom. When borrowing is cheap, demand for assets skyrockets. Stocks, real estate, even exotic stuff like art and vintage cars, everything that can store value or grow in price gets bid up. Who owns those assets? Not the average person with $2,000 in a savings account. The rich do. So every time the Fed cuts rates, it's like hitting the boost button on their wealth. Let's make it visual. Imagine two people. Person A has $50,000 in savings. After the rate cut, their interest income drops from $1,500 a year to $500. Person B owns $10 million in real estate. After the rate cut, their property values jump 10%, adding $1 million to their net worth without lifting a finger. Same economy, same Fed decision, two completely different outcomes. The psychology of the wealthy. Here's the thing. The rich don't just sit back and let money happen to them. They anticipate what the Fed is going to do, and they position themselves early. You know what most people do when they hear rate cuts? They shrug and think, cool, maybe my credit card interests will drop. Meanwhile, the wealthy are calling their brokers, their bankers, and saying, load me up on real estate deals, margin loans, and growth stocks. They know that when money gets cheaper, the game changes completely. Why this matters for you, you might be thinking, okay, but I'm not rich, so what's the point? Here's the point. You can play the same game on a smaller scale. You don't need to borrow millions, but you can take advantage of the trends. If you know that cheap money is coming, you know where the wave will hit. Stocks, real estate, maybe even crypto. The average person doesn't see it. They think interest rates boring, but the rich, they see opportunity and they sprint toward it. A real-world example, let's rewind to March 2020. The pandemic hits. The Fed slashes rates to zero and starts pumping money into the economy like never before. What happened next? The stock market soared. Tech stocks like Apple, Amazon, and Tesla went parabolic. Real estate prices climbed because mortgages were at record lows. Crypto had one of its biggest bull runs ever. Who made the most money? People who recognized the playbook and acted before the headlines told everyone else. It's not about being lucky, it's about being ready. The rich aren't magical, they're just prepared. They study the FED like their lives depend on it because, in a way, they do. They know the Fed controls the flow of money, and the flow of money controls asset prices. So when Jerome Powell or whoever is running the Fed says, we're cutting rates, they don't ask what does that mean. They ask, where do I deploy my capital right now? The silent killer. Inflation. Here's another reason the rich love low rates. They hate inflation more than you do. Inflation eats cash alive. When rates are low and inflation creeps up, holding money in a bank account is financial suicide. So what do? They dumped cash into assets that rise faster than inflation: stocks, real estate, even commodities. This way, not only do they protect their wealth, but they also grow it. Meanwhile, the average person holds on to cash, thinking it's safe, and then wonders why everything feels more expensive every year. The takeaway: when the Fed cuts rates, the rich see it as the biggest green light of the decade. They borrow more, buy more, and watch their wealth multiply while everyone else complains about rising grocery prices. Here's the hard truth. The system is designed this way, and you can either complain about it or learn the rules and play the game. In the next part, we're going to dig into why cheap money is both an opportunity and a trap, and how not to blow your chance to get ahead while the window is open. How cheap money can make you rich or broke. Let's be clear. When interest rates drop, the game flips. Suddenly, borrowing feels like a cheat code. Credit is cheap, deals look juicy, and everyone starts thinking, this is my time to shine. But here's the ugly truth. Cheap money is a double-edged sword. It can make you rich faster than you ever imagined or bury you under a mountain of debt so deep you will need a flashlight and a prayer to get out. So let us break it down. How do some people ride the wave to wealth while others wipe out completely? Step 1. The seduction of cheap credit. When the Fed lowers rates, banks loosen their grip, loans get easier, credit lines get bigger, and suddenly, the guy who couldn't qualify for a mortgage last year is buying his dream house. Businesses do the same. They borrow like crazy to expand, buy equipment, or just stock up on inventory. Sounds great, right? More money flowing, more opportunities. But here's the trap. Easy money makes people reckless. When debt feels cheap, people start saying dangerous things like, who cares about the price, I'll just borrow more. That's how bubbles form. Step 2. The leverage illusion. Leverage is like fire. In the hands of a skilled chef, it cooks a 5-star meal. In the hands of a toddler, you've got a house fire. When interest rates are low, leverage looks harmless, even sexy. Borrow at 3%, invest in something returning 8%, and boom, you're a genius. But here's the problem. Markets don't always play along. What if that stock you leveraged into drops 30%? What if your rental property sits empty for 6 months? Suddenly, the debt that looked harmless becomes a wrecking ball swinging straight at your bank account. This is why smart investors use leverage carefully. The wealthy don't just borrow because they can, they borrow because they fund for every scenario, including the bad ones. The people who get hurt most, who usually blows up when money gets cheap. The overconfident and the underprepared. Think back to 2008. Low rates fueled a housing boom. People were flipping houses like they were cards. Everyone thought they were a real estate genius until the music stopped. When the crash hit, the highly leveraged were the first to go bankrupt, not because they were bad people but because they confused easy credit with guaranteed success. The people who win big on the flip side, who made billions, The ones who understood the game and stayed disciplined, they borrowed at the bottom, bought undervalued assets, and held long-term. The big money was made by people who respected leverage and managed risk. That's the secret nobody on TikTok wants to tell you, because slow and steady dose and tea go viral. How to play it smart. So, how do you take advantage of cheap money without becoming the next cautionary tale? Here are 3 golden rules. Rule number 1. Borrow for assets, not liabilities. If you're using cheap credit to buy stuff that makes you money, like real estate or a business, cool. If you're using it to buy a boat, a designer wardrobe, or a vacation to Bali, you're not playing the wealth game, you're playing the broke game. Rule number 2. Stress test your plan. Ask yourself, what if rates go back up? What if my investment drops 30%? Can I still cover the debt? If the answer is no, rethink the move. The rich never gamble without a parachute. Rule number 3. Avoid the FOMO trap. When rates drop, hype takes over. Everyone around you will say things like, "You're crazy if you're not borrowing right now." That's when people make the dumbest decisions. Tune out the noise. Stick to math, not emotion. Real-world case study. The 2 entrepreneurs, meet Sarah and Mike, both own small businesses. Both see the Fed/rates. Sarah's move. She borrows $500,000 at 3% and uses it to expand her business, which already has strong profits. She buys new equipment, hires staff, and increases production. Within 2 years, her revenue doubles. Mike's move. He borrows $500,000 and spends it on flashy marketing campaigns and a bigger office. Because hey, money is cheap. Problem: his business wasn't solid to begin with. When the economy slows down, he can't pay the loans. Mike goes bankrupt. Same rate cut, same access to credit. 2 totally different outcomes because of strategy. The hidden danger, the snapback. What happens when the Fed eventually raises rates again? That's when reality hits hard. If you borrowed too much, suddenly your payments skyrocket. If asset prices fall, you might owe more than your investments are worth. This is why smart investors don't just plan for today, they plan for tomorrow. The takeaway: cheap money is a gift, but only if you know how to use it. For the disciplined, it's the chance of a lifetime. For the reckless, it's a ticking time bomb. Here's the mindset shift you need. Don't chase money because it's easy. Chase opportunities that make sense, whether rates are 0% or 10%. In the next part, we're going to cover exactly what moves you can make right now to position yourself for the Fed's next big play and how to start building wealth even if you're not rich yet. Step 5. Build a rate-hedged portfolio. Rates won't stay low forever. The Fed always changes the game eventually. So, protect yourself by not going all in on one strategy. Balance real estate, equities, and some safe assets. Avoiding variable rate debt if you can lock fixed. Having an exit plan if you use leverage. Know how to unwind before trouble hits. Step 6. Play offense, but keep defense. The best investors think like this. How do I make money if I am right and survive if I am wrong? So, as you move forward, if you borrow for assets that pay you. If you invest for cash flow first, speculation second. If you spend, make sure every dollar is working like a soldier, not sitting on the couch eating chips. Case study. The power of positioning. Imagine 2 people, Alex and Jordan. The Fed cuts rates. Alex does nothing. He scrolls TikTok, complains about inflation, and hopes for a raise. Jordan acts. She refinances her mortgage at a lower rate, freeing up $500 a month. She invests that into dividend stocks and sets aside $10,000 as a deal fund. 6 months later, a small rental property hits the market. She buys it with a cheap mortgage. Within 2 years, her cash flow doubles. Same economy, same rates, different mindset. What not to do before we wrap this up? Let me save you from the mistakes that break most people. Don't borrow for lifestyle. A $50,000 loan for a Tesla is not an investment, it's an anchor. Don't max out just because you can. Lenders will happily give you enough rope to hang yourself. Don't skip the math. If your plan only works in a perfect economy, it's not a plan, it's a fantasy. Your 90-day game plan: here's what you should do in the next 3 months. Kill high-interest debt. Stack cash for opportunities. Research assets that perform in low-rate environments. Plan your leverage strategy before you borrow. Do this, and you won't just survive a rate cut, you'll thrive from it. The Fed doesn't control your financial destiny, you do. Rate cuts create windows of opportunity, but windows close. The question is, will you be ready when they open? In the next episode or chapter, I'll show you real-life examples of ordinary people who built wealth during rate cuts and how you can copy their playbook step by step. The action plan. How to profit from rate cuts without losing your shirt. All right. You've made it this far. You understand the game. When the Fed cuts rates, it's not random, it's strategy. And you know the difference between smart leverage and financial suicide. Now, let's talk action. Because information without execution is just financial entertainment. The question is, what can you do right now to position yourself for wealth while everyone else is either panicking or making dumb moves? Step 1. Audit your money like a CFO before you think about investing or borrowing. Know your numbers cold. Most people have no idea where their money goes. They're running blind. Ask yourself, what's my monthly cash flow? How much debt am I carrying? And at what rates? What's my current net worth? You need these answers because the first rule of winning the rate cut game is protect your downside. Here's the move. If you have high-interest debt, credit cards at 20%, personal loans at 12%, kill those first. There's no point trying to invest at 8% if your debt is eating 20%. Step 2. Build your war chest when rates drop. Opportunities pop up everywhere. Cheap mortgages, undervalued businesses, stock discounts. But if you don't have cash ready, you can't play. So, before you YOLO into the market, stack liquidity. That means cut unnecessary expenses, sell junk you don't need, build a savings buffer. This isn't sexy, but it's the difference between watching opportunities and grabbing them. Step 3. Invest where cheap money works for you. When the Fed cuts rates, these areas usually heat up. Real estate, mortgages get cheaper, so buying or refinancing property becomes attractive. Stocks. Lower rates often push people out of bonds and into equities, boosting markets. Businesses. Cheaper loans make expansion easier. But here's the catch. Don't chase hype. Don't buy just because everyone on social media is screaming to the moon. Instead, look for assets that cash flow: rental properties, dividend stocks. Stick to industries that thrive in low-rate environments: housing, tech, consumer spending. Avoid junk companies that only survive because borrowing is cheap. They collapse when rates go back up. Step 4. Lock in long-term advantage. Here's a pro move the rich love. Locking in cheap debt long-term. Why? Because if you can borrow at 3% for 30 years and inflation runs at 4%, you're basically getting paid to borrow. That's how fortunes are made quietly. Example, you buy a rental property now with a 30-year fixed mortgage at 3%. Even if rents only rise with inflation, your payment stays the same while income climbs. That's the power of long-term leverage.